for those individuals who do want to pay off their home early, what are the most common methods to be used?
Definitely. So the number one method I would say people use right now to pay off their home early is just sending extra money on top of their normal mortgage payment. So if your mortgage payment is $1,500 a month, maybe you send $1,600 a month, and that extra $100 goes to pay off your mortgage quicker. You could do that in any denomination. I have people sending an extra $20 a month. I have others sending an extra $1,000 a month. So spending or paying extra money on your principal is the quickest and easiest way to accelerate the pay down of your mortgage. The second thing would be, and putting that idea on steroids, would be actually refinancing your mortgage to shorten the term of the loan. Maybe you had a 30-year mortgage, you've been paying on it for 5 years, you have 25 years left. Maybe now with interest rates being so favorable, home equity going up, maybe now it makes sense to go and let's take you from 25 years down to 20 years left on your mortgage, shave off 5 years. Or let's take you down to a 15-year mortgage. The shortest term mortgage that I will typically do is a 10-year mortgage. You can obviously pay extra,
Sure,
but contractually, a 10-year mortgage can be a wise move if you want to pay your house off early. So 10 and 15 year are really common for people that want to refinance because they offer such favorable interest rates. Those are going to be, much lower rates in many cases than a 30-year mortgage or even a 20-year. And then the last idea I want to touch on here, people that want to pay their home off early, is going to be doing a biweekly payment. So that's where you have the mortgage coming out every 2 weeks from your bank account or paycheck versus once a month. And what that does is it makes it so that you're making one extra mortgage payment per year.
no,
That may not sound
per
significant.
month.
No, one extra mortgage payment per year. Because if you actually look at a biweekly schedule, over the entire year, you end up making one extra mortgage payment. So if your mortgage payment's $2,000 a month, that's one extra $2,000 payment over the course of an entire year. And that may not sound significant, but over a period of time, you could pay off a 30-year mortgage. Depending on what the rate is on that 30-year mortgage, you would pay it off in about 23 to 24 years just by switching to a biweekly payment. And if you don't want to switch to a biweekly payment because you only get paid once a month, or you get paid in a different way where that doesn't make sense, you can accomplish the exact same thing by taking your mortgage payment on a calculator, divide the mortgage payment by 12. Whatever the calculator spits out, add that amount to your mortgage every month. You'll accomplish the exact same thing as a biweekly mortgage just by adding that extra, typically it's a few $100s, if that, per month, onto your regular mortgage payment. Just write it extra onto the check or put in the area on your payment coupon where it says additional principal, put in that extra amount, and that's going to accomplish the exact same thing as a biweekly mortgage payment. Really common strategy.
Can you add more to your like if you're to use your example, you got $2,000 a month for your mortgage. Are you allowed to write a check every month for $2,400?
Absolutely.
$2,500?
Yes. So before the housing crisis, many homeowners in Connecticut had a prepayment penalty on their loan. It was very common in the early 2000s that you couldn't pay extra on your mortgage more than a certain threshold, or you would be penalized many thousands of dollars. That law was completely outlawed. Most states, and Connecticut was one of them, that outlawed prepayment penalties on the majority of mortgages. So now, if you've taken a mortgage really any time in the last 10 or 12 years, you will not have a prepayment penalty on your mortgage. You can look at your mortgage paperwork, or if it's a recent closing, you can look at your closing disclosure that will show right there whether there's any prepayment penalty or not on your loan. And like I said, in almost all cases, there is no penalty. You can send as much money as you want extra on top of your regular mortgage payment, and you will not be penalized. But remember, when you send that money in, it's a one-way street. It only goes in. You can't call them the next month and say, hey, my hot water heater broke. I need that extra $1,000 back. That's why you want to be really careful. If you're going to send extra money to your mortgage, make sure it's money that you don't need, because there's only two ways to get it back: selling your house or getting a mortgage against it.
Ooh. How about unconventional ways? There's got to be, like, I like to say this all the time. Try to think outside the box. Be unique. Be a little bit different as far as your strategies. So can you talk about maybe a few unconventional or outside the box strategies to pay off a mortgage early?
There's two strategies that I'm thinking of here for this.
Oh, good.
Number one, and this is going to sound crazy, but it's actually one of the most effective strategies that high net worth
Good.
individuals have been using for decades. And it involves a home equity line of credit. So it either would be refinancing your first mortgage into a home equity line of credit. Again, I know that sounds crazy. Or it involves taking a second loan or a secondary home equity line of credit in addition to your first mortgage. Why would you do that? Because you can use that home equity line of credit as a cash flow tool to actually pay down your mortgage principal. We don't have enough time on this show to get into all the details. I do talk about that in an entire chapter in my book. But for those that are interested, the concept is known as velocity banking. You can look up that, a money merge account, or an all-in-one mortgage. Actually, this is the most common mortgage in Australia and New Zealand is something called an all-in-one mortgage, which it's not a 30-year fixed or a 20-year fixed or a 15-year fixed. It's actually an adjustable mortgage. It replaces a mortgage with a home equity line of credit. And the concept is it only works for people that have positive cash flow. So if you're in the negative every month, this will not work. Like I said, high net worth, high income individuals have been using this for decades. And it involves putting all of the money that you get on a monthly basis into that line of credit. Literally every dime. If you make $5,000 a month at your job, you put the entire $5,000 on the line of credit. Then from there, as bills are due, you take money out of the line of credit because a line of credit goes both ways, unlike a fixed rate mortgage. It's open end, not closed end. So when your bills come due, you have a credit card due for $1,500. You simply take the money out of the home equity line of credit and transfer it over to the credit card. The idea is that on a home equity line of credit, the interest is calculated on a daily basis, on an average daily balance. So by having that money sitting in that account, just like a checking account that's earning interest, it's earning you an effective interest rate equal to that line of credit rate. So it allows you to pay that down that much quicker.
So the interest rate isn't higher on the line of credit than it would be for an actual conventional mortgage.
Sometimes it is. Sometimes it isn't. Right now, obviously, the rates are very favorable. But years from now, a home equity line, and years ago, they were actually higher. The home equity line of credit strategy, the all-in-one mortgage, the velocity banking strategy, it's really not focused on the interest rate. This will work even if your line of credit interest rate is 8 or 10%. To implement it, so we can dedicate a future show to it. But if you're interested, that is what it's called. And like I said, very common. It's actually the norm in Australia and New Zealand. This is what everyone gets here, just like the 30-year fix is what they get here. The second unconventional method that I know we touched on previous shows about is a debt consolidation refinance, where you use the money that you're saving to apply to the principal on the mortgage. And that's the part most people tune out, or they just hear debt consolidation refinance. They don't take the extra step to say, okay, I'm saving $800 a month by consolidating my debt into my mortgage. Great, that improves my cash flow. But now let's take the next step. What if you took the $800 a month you're saving, or a portion of that? Maybe it's $500 a month. Maybe it's $300 a month. What if we took that savings that was going to interest on other debt, and we now apply that to principal on the mortgage? Now you're talking about paying off a 30-year mortgage, in many cases, 8 to 10 years, without even changing your budget, because we took the money that was going to the banks, credit card companies, personal loans. We're recapturing that. And now, sure, you could put it in your back pocket. But if you want to pay off your house early, let's redirect that and put it on the principal. Imagine how quick you could pay your mortgage off if you were putting an extra $300, $500, $1,000 a month on the principal. This is how people are paying their home off in 1/2 to 1/3 the time without even changing their budget.
And it automatically goes to principal when you pay above and beyond what your payment is due.
In most cases, yes. Some servicers of mortgages get sneaky and they'll put the money in the escrow account, or they'll put it in what's called a suspense balance. So if this is something that you're thinking about doing, paying extra on your mortgage, whether it's through a debt consolidation refinance or just spending an extra $100 a month on the mortgage you have right now, make sure that you indicate either on the check, on the payment coupon, on the online payment program that you're using, there'll be a little line item for additional principal. break that out, put that extra amount where it says additional principal,